Tēnā koutou katoa. Ko Amelia Sharman toku ingoa, and I am pleased to welcome you here today to our webinar on entity-level scenario analysis. With me, I have Jack Bissett, Policy Manager, who will be taking you through some of the core content today. And this webinar, as you know, is in support of the guidance published by the External Reporting Board, which you can find on the Climate Resources page of our website. So today we'll be running you through the key elements, but I highly encourage you to go to the website and download yourself a copy if you haven't already. So what are we going to be focusing on today? We want to run through the following three main topics. First, specific considerations for the finance sector. Second, the big picture of why treating scenario analysis as a valuable exercise is important, and also how it fits into that journey to transition planning. And third, we'll go through the 6 main steps of scenario analysis, which are detailed in the guidance. All of that should take about 30 minutes because we then want to open the floor to questions. So please put your questions in the Q&A box as we go. We'll probably tackle most of them at the end, but we'll try to answer some as we go if there are particularly pertinent ones per step. So now I will pass over to Jack, to go on with the finance sector considerations. Thanks, Jack.
Thanks, Amelia. Kia ora koutou katoa. Ko Jack Bissett toku ingoa. I hope you are well, and big hello from sunny Christchurch. Getting very warm in here. But yes, looking forward to the webinar. I thought we'd jump straight into some specific examples and considerations for finance sector, as I know that that's where a lot of the interest is. So first up is an example from the UK, Baillie Gifford, a UK-based fund manager with an equities focus. And yeah, this is an interesting example. So in 2021, on the left here, they've started out quantitatively. So they've effectively approached scenario analysis as more of a modeling exercise. And so that since 2021, they've since started to move their approach. And this is something that's interesting from our perspective in New Zealand, because we're really trying to emphasize starting more on this right-hand side than on the left, which is more of a qualitative-led and a more narrative-led approach to scenario analysis. So the good news that we're hoping to share today is that we think in New Zealand we're in a good position and avoiding the situation where there's a sort of need to redo or really take quite a different approach. And so, yeah, we can see this example here where the modeling moves more to a narrative-led approach. And so the second example is the university's superannuation scheme. So in 2022, they also started out quantitatively with a modelling approach, and now in 2023, we can see that they're also adopting, again, this similar narrative-led approach. And one of the reasons that we can start to see coming through is this idea that there can be significant limitations with the modelling approach. And part of this is a concern that if there's sort of a use of models too soon in the process of exploring climate-related risk and opportunity, that there can be an underestimation and risks can be missed. So this is an important point to be across. And so some of the other limitations that they note as they've started to shift away more recently, in their view, that, well, their initial approach didn't capture the complex interrelated risks of climate change. They don't model climate tipping points, where a small climate change in the climate can trigger large and often unstoppable change elsewhere. They often look at risks in isolation. They miss knock-on effects, things like political and social instability. They use very long time horizons with smooth kind of linear transitions, which they're effectively not actually expecting in reality when they think through from their own perspective what they think the transition is going to look like. So they're, effectively pointing out that to really embed this into decision making, there's a real need to make sure that the scenario analysis is something that the entity itself can actually properly see as plausible, and if not, it struggles to make it past that sort of one and done type of approach. And so yeah, USS here basically says that they're aiming to lead the development of a new approach to climate scenario analysis that's less focused on this idea of precise estimation or numbers, and more on understanding how real world dynamics could play out in a complex world where climate risks cannot be looked at in isolation from political, economic, and technological factors. So by improving your understanding of this space of scenario analysis globally, we think that there is a real potential to be avoiding this emerging global concern around that many of the existing models are underestimating climate risk. So a few further tips to help avoid this type of underestimation, and some of the way the USS had described it was, a risk of falling into the trap where the models say it's all okay, but they sort of have a lingering sense that might not be, what these scenarios should really look like. So yeah, some of these tips here on the list is to avoid confusing models with reality. Really being true to the method of scenario analysis, which is, what we've laid out in the guidance here. Understanding the difference between scenario analysis and modeling, which is something that can be take a little bit of time to get your head around and is a wee bit tricky. Improve your understanding of the assumptions and the limitations of existing climate scenarios that already exist that you may be looking to draw on. Start qualitatively and build in quantification as part of a robust process, and then not to think about scenario analysis as something that's done to you or to your loan book or part of your business that you're looking at, but rather something that's done by yourself, again, with a robust process. So there is, as I mentioned, I think a combination of a growing concern around models underestimating climate risk, but at the same time, an appreciation for the fact that, well, the only way to move beyond that is to do our best with a more narrative-led approach that is, more exploratory, and really, just involves good hard scenario analysis work. So these are some kind of growing body of recent reports with tips and tricks for how to navigate this space. And I guess particularly important for banking and insurance is this, is the position of the NGFS and where they're going to. So I think, if I was to think back of since the NGFS was first established and the way that it's played out in terms of their relationship with the TCFD is that, the NGFS has probably been in that space of encouraging quite a model dominant approach globally, and an approach that is probably more focused on risk as well, and as opposed to strategy, which is where the TCFD has gone and probably elaborated on more so with the non-financial entities. And so now it's interesting to see, after quite a lot of global experience over the past maybe 3 to 5 years around climate-related scenario analysis for the finance sector, is that, again, I think we're starting to see this increasing acknowledgement that a model-first approach has limits, and that, the way to deal with those limitations tends to be with more narrative and more qualitative-led scenario analysis. And some of the particular points there is to really be thinking hard about what time horizons that you're going to be using. Sometimes there's a default to quite long-term time horizons, which can help to bring in things like making sure that the physical risks of climate change are starting to be understood, but at the same time they can be that can cause difficulty in terms of using them for actual decision making and integration into strategy and decision making. Again, there are potential short-term dynamics that are quite interesting to explore, but those can be sort of skated over if that longer-term time horizon is taken. The difficulty, though, is that there can be a really diverse variety of different transmission channels for how financial institutions can be impacted by climate change. So that means there's effectively a need to be exploring many different sources of shocks in these narratives, and a note that there tends to be still this difficulty, particularly around economic assumptions of relying on macroeconomic models that are typically equilibrium in nature, which is tricky because the idea of equilibrium is a little bit challenged by climate risk, and financial institutions and everybody really tends to like to have an economic model to rely on for economic assumptions rather than trying to work out and make careful judgments about what assumptions are plausible given the other climate risk variables in play. So interesting to see the NGFS moving on this too, with this note on short-term climate scenarios. And then another important point is this, again, zooming in on banks and insurers. So basically a couple of KPMG reports here. I touched on this in the previous slide with the NGFS, but this kind of evolution that's going on where scenario analysis is moving from effectively more of a risk only exercise towards a risk and strategy exercise. So KPMG notes here that most banks currently use scenario analysis to assess risks. So it's not yet clear that they're being or how they're being used to evaluate the resilience of their strategy, which then is assumed to move forward to actual changes to the strategy. And for insurers on the bottom, again, same finding, and so noting at the bottom there that there's clearly more work to be done in this area. So I think you shouldn't feel like this is a specific issue for New Zealand. I mean, this is a KPMG global report. Everybody's effectively learning and improving on their scenario analysis as they go. So, I mean, the only thing I'd emphasize, as well as what's on the slide here, is not to forget that your own strategy and your own business model are the things that are supposed to ultimately be tested by scenario analysis. So that takes a bit of time to get there. But we do hear a little bit from banks around their focus, I guess, on risks and climate risk being faced by their customers, and with insurers risk being faced, say, by communities and regions. We hear less about risks to the success of the bank or the insurer's actual own existing strategy and how they're thinking that through. So you should be thinking a lot and reflecting on your existing strategy, and that means questions like, well, which markets are you focused on? Is it agricultural mortgages? Is it motor vehicle insurance? What assumptions does your existing strategy rely on? What assumptions are then being challenged through the process of scenario analysis, and then that moving through to, well, how could we potentially make strategy changes off the back of that exercise? Another important consideration for financial sector in the New Zealand regime is the fact that the NZBA, the Banking Association, has brought together banking sector to develop sector level climate scenarios, which was something that the XRB was encouraging for all sectors over the last year or so. And so these sector level scenarios do exist, and General Insurance has also done this through the Insurance Council of New Zealand, and the Financial Services Council brought together the fund manager community as well as health and life insurance. So there's sector level scenario analysis available for what should be most parts of the whole finance sector in New Zealand. So if you're not familiar with these already, we've got links on our website and in these slides to those documents. And I guess the key points that we'd emphasize in terms of any financial sector organization looking to actually use these is to do so carefully. While this can be a useful resource to help take some of the initial work out of translating global and domestic assumptions about physical and transition risks down to the banking sector level, for example, that is, there's still a need for the bank itself or any one individual climate reporting entity to effectively be responsible for their own scenarios. Obviously these can act as a good reference point for external communication with primary users, but there is a balance there with making sure that you're exploring things and risks that are specific to you, and again trying to be true to that good robust scenario analysis method. And here's just a quick slide with the status of some of the other sectors in the regime. So we've got about 14 sectors, plenty of corporate sectors in addition to the finance sectors as well, now doing this work, with most kind of coming towards the end of completion. So I think this puts us in a good position in New Zealand in terms of consistency and comparability, with some difference of assumptions, but ultimately some good convergence going on in the country and in the regime. So yes, a good starting point, but really the hard work is going on at entity level.
Thanks, Jack. So don't forget to keep putting your questions in the Q&A, and we'll get to those at the end. And now, after getting a bit into the specifics of the financial sector, we want to rewind a bit and look up at that big picture. And we think that that's really important because it gives critical context to the rationale of each of the 6 steps in the scenario analysis process that we'll talk through in part 3 of this webinar. So firstly, where does this guidance document fit into the climate reporting entities' disclosure requirements? So the disclosures that climate reporting entities make under the Aotearoa New Zealand climate standards are about explaining an entity's journey to better manage climate-related risks and opportunities. So as you may know, we have issued all sectors staff guidance, which aims to help entities to think about what primary users are looking for from the disclosures themselves. And the Financial Markets Authority has also issued several pieces of guidance relating to their regulation of the reporting. This guidance on entity-level scenario analysis is different in that it's about the mahi behind the disclosures and to support the entities to get the most value from the scenario analysis process itself. So think about the all sectors guidance being about the disclosures, and this is about the process underlying the disclosures. So scenario analysis, as you know, fits into the strategy section of the standards. And so we do also encourage entities to keep the purpose statement of the standards in mind, which you can see on screen here. So that purpose statement is really, really important because it gives context to why entities are being asked to do this work and think about the disclosure. And then as a reminder, this guidance, again, is neither mandatory nor binding on entities. It does not have the force of law, and nor does it amend or provide any binding interpretation of the standards. We just hope that it's really useful for you while you're doing the work. I'd also say one thing when reporting against a standard is that keeping definitions in mind is really fundamental when it comes to using standards. And I'll read out the full definition because I really want you to keep that in mind as we go through the next steps. So it's defined as a plausible, challenging description of how the future may develop based on a coherent and internally consistent set of assumptions about key driving forces and relationships, covering both physical and transition risks in an integrated manner. And those words will pop up again in those 6 steps we'll talk through. The definition also goes on to say that climate-related scenarios are not intended to be probabilistic or predictive, or to identify the most likely outcome or outcomes of climate change. So they're not models. They are intended to provide an opportunity for entities to develop their internal capacity to better understand and prepare for the uncertain future impacts of climate change. And that's really that strategy point. This work is about strategy. So what does this then mean for you in the finance sector thinking about this definition? Really, climate-related scenario analysis should be able to help you answer fundamental strategic questions like, how do we ensure that our business model and strategy can remain resilient to climate risk and build resilience in? What markets are we focused on? And will these markets remain profitable for us in different climate-related scenarios? And what could we do to support continued profitability, depending on which scenario, we're looking at? What strategic pivots may we need to make, and how well placed are we to pivot based on all the learning that we've done in that process? We'd also like to highlight this image from the guidance, which is about what scenarios are and are not. Some of these, again, will be expanded on as part of the 6-step process, but I would encourage you to keep these rules of engagement in mind as you go through the process yourself at your end. And finally, scenario analysis fits within a really important wider context, which is in the standards. Entities need to embark on a journey going from scenario analysis all the way down to transition planning. The disclosures are a way to explain this journey to primary users. But, as Jack has said, we don't underestimate how challenging this journey can be, but also how potentially transformational it can be at the same time. And we really want to leave you with a message that entities that embrace this whole process will be in a better position to navigate an increasingly uncertain future. So we have guidance on the sector scenario development, which is that voluntary process and not required by the standards, and transition planning. And we're happy to actually answer any questions about any of those in this webinar as well, if you have any questions on those topics. So don't forget, keep putting your questions in the Q&A, and now I'll hand back to Jack to talk about the guidance itself.
Thanks, Amelia. Okay, great. So yeah, in this section of the presentation today, I'll basically be giving you a sales pitch for why you should go and actually read the guidance in more detail after this session. So I'll give you a quick overview of what's in there. We've effectively drawn on existing TCFD guidance, and we've initially fed that through into the sector level scenario analysis guidance document we put together back in July, and now we've gone effectively straight from the TCFD with specific tips and tricks for how to draw on any sector level scenario analysis that does exist, or if you're choosing either not to use the sector level scenario analysis, what our view, which is effectively very much based on a TCFD view of a robust scenario analysis process, actually looks like. So just a few very quick introductory remarks on scenario analysis in general. Has been used as a strategy tool for a very long time. When done well, it proves useful and powerful for decision making and strategy, and that again is a bit of a caveat because can take a little bit of warming up to actually do it well. And I think most people and everybody we've met who's done scenario analysis once would, I think, tend to say that they've got room for improvement, and that it's been stretching thinking, but it ultimately is a tool, and so using the tool more than once means it'll be done better and hopefully done well enough to inform decision making. It's as much as an art as it is a science, and there are some pitfalls that some are finding. We're trying to help entities navigate that, and I guess a key baseline outcome of scenario analysis is to really confront business as usual thinking and to be effectively changing our mental models about what are the issues that we're facing in the future and how might we best navigate those. And it can be a lot of work to put this together, and so ultimately it's that connection with decision making that is a crucial nexus point for making sure there's value. And so I think those that do it and come out the other end with not too many plans to make any different decisions are starting to scratch their heads about why would we be putting all this effort in, and that's really where the emphasis again is on, this is a strategy tool. It's been around as a strategy tool for a long time. So just doing it for doing its sake or for disclosure's sake is really not the best way to approach this. Few slightly more optimistic and positive cheery points. Anybody can do it, even though it's hard. It's equally hard for everybody. It's scalable, so it is quite a generic method, and you can think about it quite simply as putting time aside to have a conversation internally or a series of conversations internally around the future with a strong climate change lens on the future, but effectively that is the best we can do when we've got this much uncertainty. It can also improve connections both internally and externally, including with important climate communities like the climate science data providers and climate economics communities. But also internally, we hear a lot of value in just how participatory and inclusive it needs to be with strategy, risk, finance, and particularly decision makers coming around the table. And it's also useful for identifying opportunities, which is part of getting a good sense of the risks as well, is enabling that understanding of where the bright sides are going to be for your entity and for others too. So I'm just going to run through the 6-step scenario analysis process. Hopefully you're somewhat familiar with this by now, and if not, we've got much more detail in the guidance on this. So I'll just run through this relatively quickly, looking at the time, making sure we can get into lots of questions and answers. I know that, and hoping that those are starting to come through. But these are the 6 steps at a high level. I won't read those titles out, but effectively what we've got in the guidance is at each step particular points around how you can improve consistency and comparability, key outputs, which we're recommending that you should document along the way, making sure you're forming a robust paper trail for regulatory purposes, but also to help what can be a large internal team, and if external people are involved, helping them to keep up and really, build on what's been learned and explored through each of the stage gates. And lastly, some conditions for success, basically, pushing towards that global good practice frontier, which is, evolving itself as well. So first step, engage some stakeholders, prepare an effective group, gather, people around the table. And so, this is quite a lot of work. And this is also, as we all, I think, very aware, is very much a prioritization issue around making sure that there's a mandate from the highest governance level. If sufficient time and resources is not put into this, then again, there's a higher chance that there's not going to be much value coming out the other side. So, that's tricky for everybody to fit this in alongside BAU concerns, but we would really encourage, starting strong and making sure there's time aside for real engagement with, what are very long-term, very uncertain, very complex issues that we're starting to feel more and more in our everyday lives, but which take some time to work through systematically. And probably the main thing to emphasize on this slide is to involve everybody who is involved with decision making. So if decision makers aren't involved, then their mental models are unlikely to be being challenged and kind of coming along the journey of the development of the scenario. So if a decision maker is effectively given a scenario analysis or some scenarios that they weren't involved with developing, then they're less likely to see them as plausible and therefore ultimately inform their decisions. So that's a really important point. Step 2, define the problem, or also referred to as, selecting a focal question, which organizes the whole process and all of the analysis. And so, the recommended question from the TCFD is, how could climate change plausibly affect our business model and strategy? What should we do and when? So, again, quite a strategy focused question, with some important boundaries starting to come up early on at this point in the process around, so what is the scope then of our organization, which parts of the strategy are in, and also what are the time horizons that we're going to consider. And that's, as I mentioned earlier, very important. And there are some pros and cons of these sort of shorter versus longer term decisions. And even just one last point on this slide, even just getting a really clear shared view of what your entity looks like in the broader system that it operates in can take a little bit of unpacking and making sure that everybody can agree that everybody's effectively putting the same entity to the test in the next few steps. So step 3 is where a few more kind of nerdy scenario analysis terms start to come in, like driving forces and critical uncertainty. So these are really important to actually understand, and we do see a little bit of this tendency that the words driving forces and critical uncertainties are used a little loosely, and it takes a bit of time to work out exactly how those differ from risks and opportunities. And if if that happens too quickly, then can be a bit hard to draw it all together in a really robust way. So recommend you having a look at the guidance on what these terms mean, and these have drawn from a long back catalogue of scenario literature and methodology. So just briefly though, driving forces are external factors that may affect the outcomes of the focal question. So that's where this method can become quite specific to your particular entity and the particular decisions you're making as you go through. And critical uncertainties are those driving forces that are the most influential and most uncertain. And the value of driving forces is that they help to define what each scenario should explore and the key differentiating characteristics between scenarios. So by letting key uncertainties play out in different ways, this can affect basically how risks can flow through to you and what you may do about it. Step 4 is to select temperature outcomes and different pathways for how those could be reached. And so, the important thing to bear in mind here is what's in the standard around the need to, have a 1.5 degrees and a greater than 3 degrees, 3 degrees or greater temperature warming outcomes at the minimum. And so, in the standard, it's at least one further outcome and pathway combination of your choosing. And I think we're starting to see good practice shift sort of beyond the idea of maybe 3 or 4 scenarios to even 5+. And what we've seen a little bit when entities default to 3 is that can help entities get started, but it can also lead to this kind of mental model difficulty for all of the participants of one scenario at the 1.5 degree end being seen as good, 3 degrees or greater being seen as bad, and then the other one being kind of seen as in between. And that means that they're not as useful for decision making as they could be. They're not as distinctive, and they're not as challenging, where the good one starts to look a little bit too good quite quickly, and the bad one starts to look a bit too bad, and then everybody struggles to really engage with them meaningfully. So I think that's another important consideration to bear in mind. Step 5, this is where the creatives in us are let loose, and actual narratives are written up and developed. And that's a really important aspect of this process. And when we say narrative, TCFD refers to that as movies of the future. So really trying to roll your sleeves up and putting the Steven Spielberg hat on for a minute is really actually recommended here, because if they're not creative, if they don't bring these issues to life off the page for the decision makers in a way that actually is engaging, these can turn into quite long documents that are a little hard to wade through for the best of us. So approaching this with some creativity is important, and quantification is supposed to come in most strongly at this step 5, which is certainly not sort of way up the front with sort of step 2, 3, or 4, but doing that quantification again, that should be done with a clear purpose. And so for scenario analysis, we're seeing it tending to be used to start with the size of issues, or getting a broad range of magnitudes out in terms of what climate risks flowing through to different impacts could actually look like. So again, that is where we see quantification fitting into this process. And again, we've got pointers here around, being clear about when you're using any high-level scenario architectures that are either used in the sector-level scenario analysis that you may be drawing on, or that we've recommended in the guidance in the appendix, that can help with consistency and comparability as well. So the last step is an important step, and I guess one that can be missed or is not necessarily always considered by, in scope of scenario analysis, but really should be seen as the most important step, which is to actually start to test how your business model strategy would perform in the context of each scenario that have been developed. So it's sort of moving from development of scenarios to use of the scenarios or analysis of the scenarios. People, I think, struggle with the idea that both those things are sort of all under the banner of the broader term scenario analysis, so that can be something to avoid getting caught out by. But this is also effectively the start in our minds of transition planning as well, where as you work through how your strategy will perform in each individual scenario, then you're starting to ask the questions of, well, what could we do in this scenario to perform better, to build resilience? And then by zooming out, you can see, well, which options are starting to come up across multiple scenarios, which are only coming up in some. And then those options can start to be used as inputs later into transition planning as you sort of move to actually do something about what's being learned. And, a key point is that, you as an entity are unlikely to be able to control which of these scenarios would play out. I think we'd all love to be able to have that level of control, but what we're talking about here is building resilience to the fact that we're uncertain as to which of these scenarios is actually going to play out. And so how can you get options that are working across the board and have a strategy ultimately that's not likely to be tipped up and plenty of different plausible futures that we could face. So just a quick recap on the key messages. This guidance is available now on our website. We've also got the previous guidance on sector level scenario analysis and plenty of other resources in the space available. So, time to crack on if you haven't been already. Climate related scenario analysis will help you improve your business model and strategy. That step one's really important, which is to start with a strong mandate from the highest governance level, getting a good diversity of perspectives from across your team. And if you don't do that, then you can be struggling to, get a high enough quality product out the other end and process that leads to some proper insights and different decisions out the other end. Scenario analysis involves grappling with uncertainty and making judgments, and this is one of the reasons that the TCFD recommends scenario analysis as a tool, is because it's specifically designed to be useful for managing uncertainty, and climate change really should be approached with this in mind. We shouldn't be looking for a crystal ball that gives us the answers when we look at these scenarios. We should be looking to actually explore what exactly are we uncertain about, and therefore what are we certain or more certain about, and that can really be key to navigating what's to come. And in the TCFD guidance, and we've elaborated on it as well, there's, as we start to move towards transition planning, this encouragement for a more adaptive and flexible approach to strategy. And so I think that's causing a need to reflect on, well, how do we do strategy? Are we already adaptive? What exactly does that mean to have an adaptive strategy? And how can we improve in that way as well?
Excellent, thank you, Jack. Well, we've got some great questions that have come in, so please, we've got 20 more minutes, so please put in your questions now so we can get to them today. So we'll start off with the first one, which is, what is the difference between plausible alternative scenarios and a range of probable outcomes of the future? A good business strategy and risk management would be dependent upon predicting and preventing bad outcomes. think that's a
I was-
great question to help us to get into this idea of plausibility versus probability.
Yes, that is a good question indeed. I think that kind of strikes to the heart of scenario analysis. I mean, I tend to think that, without trying to give a slightly bad answer, is that to me is fundamental about engaging with this as a strategy tool up front before you get too far down the rabbit hole of giving it a go. So I think, going back to some of the earlier slides around where this comes from, this is a strategy tool. It's been used, first and foremost in a corporate strategy context for a long time, back to the 50s, and the sort of usual example is Shell. But it's effectively a foresight tool, which is deliberately designed to say that, well, we cannot necessarily know the probabilities of everything that climate change throw at us, because there is such inherent uncertainty as to what could plausibly happen due to climate change, that the idea that we could get to the probabilities of every single possible outcome to then and for that to be effectively the tool, and so moving from that sort of plausibility realm, I think, is foresight. If you're still in a probabilistic kind of stochastic world, then you're probably in a world where you think that forecasting is the best way to navigate the future. So I think that that's a particular challenge and an important thing to grapple with for the finance sector, where there is such a strong BAU practice around using models and forecasts. And we're not here to say that those are not useful to inform decisions in some parts of the business, but we're here, and the standard is effectively here to ensure that, well, your core strategy and your core business model are at least starting to really grapple with this idea that there is such a high degree of uncertainty. There's no way that one bank anywhere in the world or one insurer anywhere in the world can control which climate outcomes we're going to face. And that means that there's a need to get more adaptive and better able to deal with the fact that we could have a really robust and challenging global transition to a low emissions economy, which would create implications for any one bank, or we could see kind of the runaway climate change, which again would create real challenges for any one bank strategy to be effective. So it's a great question. I feel like I don't even want to answer it, but I want everybody to go away and make sure that they're thinking about these things through, and then understanding how this tool could fit in for you.
Yeah, great question, and thanks for that answer. I think really, and it also helps you think about, what is it that your entity can do? What are the options for your entity, and what are the options that are, not in your control? There's a lot in climate change that, as you said, Jack, is not in your control. So it's really important to have a sense of that. We've got a couple of questions from Dennis, thank you, which are, firstly, so slide 15 mentions that scenarios are not products of external consultants. Can you please share your view on the use of external consultants, considering that there is likely to be little ESG knowledge in the company to start with?
Yes. Oh, yep. Another great question. I mean, I think that that slide is not intending to say that rule out consultants altogether. So I think I mentioned the point of try not to think of this as something that somebody external does to you or to parts of your business, but something that you do. And the role of consultants can be various, and we've got lots in the guidance on how to try to make good decisions around the use of consultants. Certainly, this is a process that requires some really good facilitation. So first question I would be asking going through this myself would be, can we really facilitate this internally? It can be a real challenge for any one person in an organization to have to be the facilitator of others, just the sort of nature of the beast that we all work in. So I think facilitation is key. Bringing in expert views is also really important, but that can be a little bit of a horses for courses. Almost you don't know until you start to get into it. So yeah, I mean, we would say if I look back over the last 5 years of scenario analysis, there has been a tendency for financial sector organizations to go to a consultant and say, do scenario analysis on me or for me. And I don't think that the ones who've done that are getting the best value out of that. So I think that means there needs to be a little bit more time put aside and sleeves rolled up, at least in terms of time committed to this from within organizations. And I think that those that are doing that are slowly but surely getting value and insight from it. But at the same time, we're early days. We're starting to use this new tool. So, it's going to be a slow, slightly slow, hopefully not too slow, road to getting, effectively a better approach to strategy and real value for the strategy out the other side.
Thanks. And then the second one from Dennis is regarding the point that we said that anyone can do it. He says, I believe there is a recommendation by XRB to have a mix of people from across the company to contribute to scenario analysis. To save time, should scenario analysis be led by a risk management employee or consultant with sector experience, or a person with a background in system dynamics, feedback loops, etc.? You mentioned at the beginning that people missed identifying impacts.
Yes, another great question. I mean, I think that obviously having someone internally who's, from all levels of the business that's clearly pegged as playing a leadership role would be recommended. But I think the idea that, one person kind of gets this job would not be something we would encourage, because ultimately these are sort of intended to be insights that go to the heart of what is our strategy, where are we playing, and what assumptions do we make about why that was a good choice. When we overlay a climate lens on that, do those assumptions hold up, or do we actually need to make changes in our assumptions about how particular markets are going to go, which is really pretty core to the so particularly those who are charged with strategy, and it's that in our view, and as we've got in the guidance, it's important then for the strategy function to be able to draw on risk and finance and leadership to then make sure there's a well-rounded view of what the plausible implications are. So I think that no matter what way you cut this, it needs to be cross-functional.
I think, yeah, I mean, it's really bringing in that diversity of thinking. We talk a lot about how diversity of thinking within the organization is really important, but also think about the diversity of thinking of people outside your entity, those people who might be in your value chain or contribute to how your entity operates, because they're going to give you those additional insights, which really will create a much richer picture, I think, of the narrative that you can come up with. We've got another question, which is, what would be a reason why an entity would not use its own sector level scenario? It seems unlikely that an entity would choose such a pathway.
Yeah, that's a good question as well. I mean, I think we would encourage every individual entity to make its own mind up about whether it will use them or not. And that includes those who may have been involved with pushing for them to be put together, leading their creation, purely because, this is new ground. So I think that, for example, if there was any given sector with, say, 5 organizations in it, I think it's likely that, say, 4 out of 5 might be better reflected than the 5th, who might happen to have some operations in a or more operations in a particular part of the world that the others don't, have a particular market or markets that they're starting to move into that others don't. And so for that 1 out of the 5, every time they're going to have to scratch their heads about, well, we can't really see that part of the business or that particular issue that we're hot on reflected in here at all, or reflected at a surface level. So then they have to say, well, how do we make sure we cover that if we think that that's a really critical issue for us? So I think we've recommended and encouraged sector level scenario analysis, but we're trying to reiterate the fact that it's entity level scenario analysis that's mandatory. And at the end of the day, every entity is responsible for the scenarios they've used. They're going to have to disclose, make disclosures about the assumptions as part of the climate standard. So if they're going to get pressure from primary users or others about why did you use those scenarios, that ultimately that does boil back down to the entity to be responsible for them, and sort of can't pass the buck back up to the sector, even if the sectoral work is helping to generally build awareness and get some momentum going on this.
And I think, there's a really reasonable case to expect that some entities might use multiple sector scenarios to inform their work. They might sit at a nexus of particular sectors. All of these things are just inputs that then would need to be really critically assessed and disclosed. And then we've got one last question live at the moment. So please, if you want any more questions from us today, please put them in now, which is, do you expect banks to understand the scenarios which are done by our material customers in order to inform our own scenario analysis? That's a great question.
Yes, I think that is another great question. I mean, I think that there is a chicken and egg situation going on for everybody at the moment, which is for their key climate risks or key customer market segments that they're looking at, that there may or may not be work done in that sector or at an individual entity level on climate risk. And so that leaves, say a bank with the needing to make the call about, what it's going to do. So I think scenario analysis tends to be the tool where these issues are not ignored. So you're effectively having to make assumptions about how climate change is going to impact others. And that at that point, then there's the question of, well, if existing work's been done, then are there insights that we can draw on or not? And if there are, it does still need to be done carefully, because that can be done, those assumptions could maybe fit into a different scenario or don't quite mash up well enough with yours to be defensible at the end of the day. So I think that is where, this process is supposed to tease this out. If there's existing material out there to draw on, then do so. But in some cases, it's forcing, say, a finance sector organisation to make assumptions about how climate change could play out for the agricultural sector globally, particularly in New Zealand, which is then, a place that we all need to go, though, because otherwise, if we're just going to be blind to it, then it's little chance that we're going to be able to have any foresight around it and make decisions on the back of it. So that would be my answer to that.
And I think over time too, we're thinking over time, as more disclosures come out, as the transition planning comes out, particular entities, that's when, I think that they then become particularly valuable inputs, as on an ongoing basis for banks, etc., to then think about. So if you have, in 2 years' time, 3 years' time, you have some really good information on transition planning from really important customers, then absolutely, I think you would be wanting to think about how you incorporate that into your own analysis. And then another question's come through, which is the perennial "what does good look like" question, which is, can you please, from Devon, thank you very much, which is, can you point us in the direction of good example scenario narratives for the banking and financial sector?
Yes, good question. I mean, I think that this is where we're at the stage where there are not too many global examples of this more qualitative narrative-led approach to scenario analysis by banks and insurers. Most of the examples are the more quantitative first approach. So there's not a wealth. I mean, New Zealand in general is leading in this area. So we're I think compared to other jurisdictions, encouraging this more qualitative approach more so than others. So I think that unfortunately, the answer partly on this particular area is, well, there's a robust method, it's tried and tested. Even looking at anybody's scenarios on the other side from an external perspective, if you weren't involved in it, can be a little bit head scratching. So it's doing a robust process and committing to it and putting heads down, bums up for a little while, that we're encouraging more so than looking for disclosures of any given scenarios. And that is challenging, and it's also partly why we've designed the standard the way we have, which is to not encourage or require so much disclosure around kind of the scenario analysis outputs, because in our view that is really where the these scenarios need to go and plug kind of right into the heart of strategy decision makers in the strategy function and in the board of these organizations, who are then going to start to say, well, this climate risk should look quite serious, have quite profound implications, and so we should have some really big important strategy questions that we're going to now work through, and that is the direction that we're encouraging more so. And we're always being asked for these kind of examples, so we always feel like we wish we could be more helpful, but that would, yes, again, be what I'd say.
Yeah, and I think, we'll make this slide pack public. We'll put it on the website so you can click on all those links and have a look at all those reports that were in the early part. And then we've just got a couple minutes left for this last question, which is what are the XRB's guidelines on using data sources for scenario analysis and climate impact factors? And I think the initial answer would be go have a look at the guidance. We've put lots of stuff in there. We've also got, don't forget to please make sure you look at Aotearoa New Zealand Climate Standard 3, which has all the disclosure requirements in it specific to scenario analysis and other parts like scope 3 greenhouse gas emissions, etc. So please go have a look at those, and don't forget that the scenario stuff in the standard is mandatory, and this is our guidance to help you. But is there anything else you want to add on that one, Jack?
No, all good. Thanks, everybody.
Awesome. Well, thank you so much, everyone, for your questions. We've really enjoyed answering them. We hope that you found this really useful. This recording will be up on our website as with the slides, as I said. So please go to the website, download a copy of the guidance if you haven't done so already, and also please give us your feedback. We're really keen to know what you found helpful about the guidance. These guidance documents are live. We do intend to update them to put more examples, etc., in over time. So thanks so much for your time, and ka kite anō.